This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Thursday morning. I'm Prashant. With me, my colleagues Sonia and Surbi is joining us here on the program today. Guys, hi, good morning. And first up, let me wish both of you a very happy Janmashtami. Yeah. Wish all our viewers a very happy Janmashtami as well.
I think Absolutely. It was pouring today, right, in Mumbai. Very poetic on Janmashtami. There's like a full downpour. But, I mean, even for the markets, I think it's pouring bullish trends. Although this morning there are some sort of headwinds. But give and take all the headwinds, this market has been moving from strength to strength, which is not bad at all.
Oh, as you said, we have some headwinds today. But I think Prashant and my colors, nice, cheerful shades of lilac and pink, or maybe making up for that, Prashant.
I mean, let's hope so.
Festive colors, yeah.
But, let's just quickly run you through what you need to know, as we always do, before we go any further. Markets building on gains, and I think it was evident yesterday as well. Yesterday, it was interesting because we started lower. The market continued to drift down till about 1:30 p.m., middle afternoon. From 1:30 to about 3 o'clock, it did nothing. It drifted slightly higher, and starting 3 p.m., the 3 p.m. move came, and that bulk of that 35-point move came in the last 30 minutes of trade. So, which basically meant that Nifty is now closed above the 50% retracement of the fall. What fall am I talking about? I'm talking about the fall from the highs of the July 20th highs to the 31st of August lows, the full fall. So, 50% retracement of this fall is 19,607. We've closed marginally above that level at 19,611, so marginally above. Okay, let's just tackle the overnight cues, which once again are not great. So I'll start with data, and then I'll get to the price action from the US. So ISM services data for the month of August in the US was a surprise. I mean, it surprisingly, in a very strong fashion, rebounded. That number stands at 54.5 compared to 52.7, which is the previous number. And by the way, services inflation is much harder to kill as compared to goods inflation. And that is the reason why markets took notice. By the way, if you look at components, prices paid, employment, new orders, all rose. The two-year yield in the US that went up, traded above the 5% mark. It's a psychological resistance. The 10-year also moved up about 3 or 4 basis points. Equity slumped. You had the S&P, which was down about 0.7. The NASDAQ was down over 1% or so. Add to this is, of course, the big pain point for us, which so far we've completely and cleanly and nicely ignored, which is oil prices, right? We are now closer to $91 a barrel. It's a little baffling. Usually, these OPEC production curtailment and cuts, etc., the reaction does not last for very long. And I don't think it should last for very long this time around as well. But we'll see. In any case, we are now at uncomfortable levels of about $91 a barrel. Let's get to the market here in terms of levels and tie all of that in. So the next major hurdle is basically we've crossed 50%. So one will look for that 50% to be held. But beyond this, the next major hurdle stands at 19,700, which is the 61.8% retracement of the July high to the August low. A close above 19,700, I mean, there's nothing then there except the all-time high of 19,991. On the way down, the 20-day moving average of 19,423 should act as a support. Lower the low, the risk-reward to try and buy the dip becomes easier. But I would still say what I said yesterday morning. If you have to do something, reduce the size a little bit. Because, I mean, global macros, etc., are not really complementing or helping you. They're not a tailwind. At the margin, they're a headwind. So positioning and the size of the position becomes important. On the Nifty Bank, we are still consolidating around the 40-day exponential moving average. It needs to close above the 44,660 level, which is the first resistance on the upside. On the way up, the Bank Nifty target is 45,312, a number we put out for a week now, which is the same retracement, 61.8% retracement of the Bank Nifty fall, which stands at 45,312. These numbers are not very far away, 3-4%, and you're there. On the way down, use yesterday's lows of 44,207 as a bit of a support, and closer to it, perhaps a little more comfort as compared to try and chase the open or chase an up move, etc. That's the kind of market we're in. The GIFT Nifty implied open will come up on your screen. And I think we are down about 34 odd points or so. Mid-caps and small caps also took a bit of a break yesterday. They were sideways. I mean, they were down between 1/4 and 0.5% at one point, but they closed absolutely flat. Sonia.
Absolutely. Prashant, I think the overall trend is still bullish, although in the very near term, there are some bearish cues sort of, providing a a roadblock to the market, right, in the very near term. So that's what we're going to talk about. The Nifty has conquered that 19,600 mark very well. In fact, the Nifty is now, less than 2% away from that all-time high, the 52-week high, that is, of 19,990. So we're not too far away from new highs. And if you look at individual pockets, right, it's IT versus banks. So IT, the Nifty IT index is now at a fresh 52-week high. In fact, stocks like HCL Tech are now up almost 20% this year. So that's where all the money has been going. While the bank Nifty, if you look at it, is up just about 3% this year, while the IT index is up almost about 12%. So it's really advantage IT and banks yet again on the back foot. So that's the way the market has been positioned so far. The Dow is down 200 points overnight, so the global cues are not that great this morning. And both foreign and domestic investors sold in the cash markets yesterday. So that as well is a bit of a bearish cue. FI sold in large quantities, about 3,200 crores. DI sold as well. In fact, there was large selling from FI seen in the mid-cap space. And we were talking about this. It's better to be cautious in the mid-cap arena because there is some froth in the mid-cap end of trade. Yesterday, there were large funds that sold in many mid-caps and hence this big FI number. We've talked about this ad nauseum as to how Brent at $91 a barrel is a headwind for the market. The dollar index at a 6-month high is a headwind for, risky assets like equities. Dollar index now at almost 105. So, yes, on the sidelines, there are definitely a lot of cues that could perhaps derail the market. But up until now, that has not happened. So clearly a bullish trend.
Well, Sonia, while I take your point that, overall the mood is still positive, but I think this rise in yields that Prashant also alluded to, that's something you can't ignore because we thought we were over and done with that after the last Fed policy. But the way Fed members have been speaking, yesterday there was another member saying that hikes are still on the table if inflation remains sticky. You tie that in with the oil narrative and we know that perhaps this is not entirely done. It's not a done deal as yet. I think in September, the CME Fed Watch tool is still saying that there'll be a pause. But in the next policy, in the November policy, there's about a 45-50% chance of a rate hike. And that's been the chatter on Wall Street all throughout this week. So those two cues that both Prashant and Sonia spoke about, the dollar index and oil, they're a big headwind, and the fact that the US 10-year is still close to the 4.3% mark. Let's add China into the mix. In a bit from now, we'll get Chinese data. Let's pull up the Hang Seng, which is a little subdued. It's down about 0.5%. Why will China become a talking point today? Because the EXIM data, export-import data, is going to be coming out. Last time, remember that number was a big howler. Exports and imports were down 14%, 12% apiece. That pace of decline in August is supposed to lower to about 9%, should reduce to about 9%. Let's see if that happens or not. So China becomes an important talking point because the excitement that we had on Monday, start of the week, about all the measures and the cut in deposit rates in China, that's beginning to wear off. We saw that yesterday, even this morning. Chinese markets are not doing too much, down about 0.5%. So China will become another talking point. And to talk about the market here, what's happened is that there is definitely a defensive shift, a defensive tilt that's very evident in prices all through this week. In fact, through this month of September, what's working in the market? It's actually IT and Pharma. Those are the sectors that have been outperforming this week and this month. And banks continue to be a laggard. That's another worry point for the market. So far this week, the bank Nifty is actually flat, underperforming the other indices. Look at the healthcare index, Pharma, IT. That's where the money has been shifting. So the good thing for the bulls is that IT has been doing some of that heavy lifting, making up for the decline in bank stocks. That's a watch point for me today, whether this trend can remain intact and counter the negativity that we have been getting in from banks. The bias is still in mid-caps and small caps, and that market's still flying away. We're up about 3 to 3.5% on the mid-cap and small-cap indices for the month of September, the last 6-7 trading sessions. Comparatively speaking, Nifty is obviously up just about 2%. Just watch for the FII selling. Sonia, you were talking about yesterday's number. If you go back and look at the data all throughout the month, we're largely negative. We're getting these big 4-digit sell figures, and that's because of the block trades. While you kind of, take that caveat in point, there's no taking away from the fact that the overall number, actually I should have put up the overall number for August, that's come down remarkably. We were getting 45,000, 46, 47,000 crores of FPI buying every single month. August, whether you're talking about April, May, June. In August, that number has dwindled to 12,200 crores. So while, yes, we do talk about all the block trade action, the net result is that the total amount of inflow that's coming in has reduced, and that's showing up in a very range-bound market.
Absolutely. And I think as we head into a couple of these big events, right, the US Fed meet on the 19th and 20th of September. Of course, in the run-up to the elections, there's so much chatter around that as well. And a lot of these commodities have been surging. So in that context, there are definitely a lot of headwinds that this market has to navigate.
You missed the Apple refresh, right? They're doing a model refresh on the 12th of September.
That's the big one to watch. So the Apple 15, the iPhone 15 is being launched. Right?
Do you guys still stay up and watch those events? I remember there used to be a rage back in the day. I'm not so sure now.
Just read about them
in the morning.
The next morning. Well, let's just quickly tell you what's lined up here in the first half hour of the show. Then we'll get you updates from markets across the globe. Cameron Brand of EPFR will discuss flows with us. Our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 in the morning, we'll get you Deepan Mehta, Velexer Equities, with a quick check on things, stocks, and sectors that he's looking at favorably.
All right, let's begin the day with some views coming in, shall we? On the equities front, we have Mahesh Nandurkar of Jefferies. He says India's Capex upcycle is visible across housing and infrastructure and also in corporate Capex. He says overall capacity utilization is near 10-year highs, with examples being cement and power. He says large Capex uptick seen in steel and chemicals also. He adds private project loan approvals also show an uptick, and with further upside likely from the PLI, data center, etc., the Capex cycle appears durable. Mahesh says multiples on related stock plays to remain elevated due to a dearth of ideas, and their preferred Capex plays are Axis Bank, ICICI Bank, SBI, L&T, Ultratech, JSW Energy, Thermax, KEI, Siemens, Supreme Industries and Kajaria. He adds Macrotech and Godrej Properties are their top property picks.
Okay, well, money market views now. This is Dhaval Dalal of Edelweiss, who says bond yields are expected to trade range-bound with an upward bias in the near term and subdued sentiment. He says rising prices of pulses and crude oil, if sustained, may have the potential to destabilize the inflation outlook. He adds hardening of US Treasury yields have also affected the mood. He expects the 10-year benchmark bond yield to trade between 7.2 to 7.25%.
Okay, we have plenty of stocks that we'll be talking about today as well, and our list of top 10 stocks will come up in a bit. Today we'll be looking at names like TCS, Shriram Finance, Ringfolk Services, JM Financial, NRB Bearing, Biocon Biologics, Paytm and ONGC, all on the back of positive news flow. PG Electroplast and Tata Consumer are the stocks that could be reacting on the red side. We'll tell you why in just a bit.
Okay, Cameron Brandt, Director of Research at EPFR Global, is now joining us to take some questions. Cameron, good to have you with us here. Thanks very much. Last time you were on the program, you were saying that flows into India-dedicated funds are still positive, while global emerging market funds, flows into GEM funds have turned negative. What's the latest picture?
That remains the picture. I suppose the good news from where you sit is that dedicated India equity funds look like they will be the star of the EM country fund groups this week. Flows into those have held up nicely so far, which is not true not only for most other emerging markets fund groups, but for most equity groups as well. It's definitely been a week of keeping your powder dry. Seeing a lot of money go into money market funds, not just in the US now, but in Japan and Europe as well. So I think people are definitely sort of taking their guard at the moment while they wait to see whether the latest spike in oil prices passes through, what the data leads the Fed and the ECB to decide later this month.
There are a lot of headwinds, though, for the emerging markets like India, right, Cameron? Whether it is higher crude prices, whether it is the spike in the dollar index. There are also some big events upon us, like the US Fed meet, as you said. How do you see the flow situation pan out from here on? Up until now, of course, you said emerging markets were the preferred piece, but do you see that continue through the course of the calendar year?
I think certainly we're going to end the year with emerging markets handily outgaining their developed markets peers in fund terms on the equity side. And my expectation is that the Fed is on hold through the rest of the year. and that U.S. data will continue to soften. So based on that, once the Fed stays on hold in September, I think there'll be renewed interest in the emerging market space. The question at the moment is whether that interest meaningfully broadens out beyond India and China, who really have dominated the flows, certainly since the middle of the second quarter.
Cameron, hi, good morning. I remember, the last couple of times we've been speaking, you've been pointing out how India dedicated funds are still bringing in the money, and plenty of it. Can you just explain what the trends are like for EM funds? Whether they're still drawing in as much of the inflow, and specifically India dedicated funds. What are the numbers saying now?
Yeah, so the answer is that the India dedicated funds are on track for another week of above average flows. And what I'm noticing too is that those flows are beginning to move beyond the funds with the large cap mandates. Those are nearly always the first ones to benefit when there is a major shift in sentiment towards an individual market. But we've been seeing pretty steady flows on a weekly basis into dedicated India funds with a Midcap mandate. And in just the past couple of weeks, we've seen an uptick in flows to dedicated India funds with small cap mandates. Now, the flows there are very noisy day to day, but the overall trend is definitely beginning to turn up.
All right, Cameron, we'll leave it at that. Thanks a lot for joining us and giving us your quick take on the market and what you're expecting to see from here on. That's a take on how the flows are panning out. But let's do one thing. Let's take a quick break on that note. On the other side of the break, we have plenty of stocks to talk about. Our entire research team will be joining in. Do stay tuned in for that. Welcome back. So the Gift Nifty is indicating a lackluster start this morning because there are plenty of headwinds, whether it is higher crude prices or the dollar index at 105. So let's see. The bulls so far have had a tight grip on the market. Let's see what happens today. But plenty of stocks in focus. Reema's joining in first up to tell us why she's tracking TCS this morning. Reema, hi.
Hi, Hi, good morning. So TCS has announced a very large deal win with JLR. It's an 800 million euro or $1 billion deal with a tenure of 5 years. Now, JLR is an existing client of TCS. But when you read the press release carefully, it says the new partnership valued at 800 million euro, which gives you a sense that perhaps this value of $1 billion or 800 million euro could be net new. But again, we do not have complete clarity because JLR is an existing client. The scope of the work is quite extensive. It spans app development, maintenance, enterprise infrastructure management, cloud migration, cybersecurity, and data services. But it's a big win for TCS, so I suspect the stock could be excited. Back to you.
Okay, well, thanks very much, Rima, for that. Well, Biocon is the next one we are going to talk about. Ekta is here with details on that one. Ekta, good morning.
Thanks for that. Well, I expect Biocon to be in the green, sentiment green, because Biocon Biologics has completed the integration of their biosimilar business in North America. Remember that they acquired Viatris's biosimilar business. Now, the company says the integration is completed ahead of schedule. The integration is effective for September 2023. Remember, the agreement closed in November of 2022. Now, the company has already integrated the business in 70 plus countries, which is basically in emerging markets earlier. This integration with North America, which is the largest piece of business for them, comes 60 days after the earlier integration. So we can expect a sentiment positive, considering that the entire biosimilar business will be chugging together now.
Okay, got that. Thanks very much, Ekta. We will keep that in mind. In fact, we'll be speaking with the management of the company as well. Management of Biocon Biologics joins in at 9:40 a.m. So do remember to tune in for that. That's Biocon in focus. But let's go to Mangalam now and talk about Tata Consumer. So, Mangalam, there's no deal after all?
There is no deal after all. There's such strong brands that it had the street conversing all of yesterday when there were reports from Reuters that Tata Consumer will go ahead and buy 51% stake in Haldiram's. Tata Consumer, on its part, told CNBC-TV18 that it do not comment on market speculation. However, to the exchanges, they've gone ahead and said that they are not in talks with Haldiram's. And both Haldiram's Nagpur and Delhi have denied reports of any acquisition or negotiation with Tata Consumer itself. Reuters had reported that they're looking for a deal at around $10 billion in terms of valuation. That itself seemed a little, over the top in terms of valuation. But now that there is a denial, it should be, it should be confirmed as a denial from both the parties. Where the stock moves today, that's the million-dollar question. Why do I say that? Because at a $10 billion value acquisition, one would have thought that the street wouldn't like the price that Tata's would be paying for it, and as a result of which the stock should have declined. But yesterday, the stock rallied about 4% So today, the first thing that we'll see is a lot of long unwinding of the long positions that were added in the second half. And thereafter, the fact that there is no big acquisition of this size, we should see some recovery from the lows.
Okay, thanks a lot for them. All I can think about is the Haldiram snacks.
The food,
when he says Haldiram's early in the morning, haven't had breakfast. Thanks, Mangalam, for getting us all hungry about that.
Sonia, the snacks you can still get. What you can't get is like Delhi, you can walk into Haldiram store and order chaat and you can order whatever else, right?
Now he's spoken
Hot
like
food.
a true Delhiite.
The other stuff you can, you can buy off the shelf, right? I mean, the bhujia and the other stuff.
But she's talking about the snacks only, the true snacks that you get at a Haldiram outlet in the north.
Yeah, okay. I'm going to take you up on that one. The hot snacks. But let's go across to Nimesh now. He's tracking some block deals this morning. He's been tracking block deals, I think, for the last 2 months. But Nimesh, what's the latest that you're looking at?
Hi, Sonia. I know I'll talk about the large blocks, but if you look at the FI data yesterday, there was a sell figure of almost 3,200 crores, but that was largely because there's some large blocks worth 1,100 crores where the FIs were sellers. Now, in terms of large block, capital seems to be quite active in terms of the sell side. They've sold large blocks in Shriram Finance. They sold close to 50 lakh shares. That was worth 880 crores. There was another large block by capital. They sold nearly 15 lakh shares in Dreamflux as well. Looks like it was a clean-out trade, and there that was worth close to 66 crores. Some other important block deals. There was a large block in JM Financial. Quant Mutual Fund was a single buyer there. 95 lakh shares bought. That was almost 70 crore worth, and there was a clean-out trade from a Mauritius-based entity. So that was JM Financial. I'll go with green JM Financial as well. The other was NRB Bearing, Acacia Partners, which owns close to 6% equity in the company. They sold nearly 2% stake, and that was worth close to 53 crores. And there was a large block in PG Electroplast as well. Bearings Private Equity, who's been a large holder in that, they've sold nearly 2 lakh shares, and that was worth 35 crores. So large block deals, and looks like capital was very active in the India portfolio on the sell side.
Okay, got that. Thanks very much, Nimish, for that. We'll watch out for how a lot of these stocks react. Let's also talk about Paytm. Yash is joining in. Yash, I think so much happening at this global fintech summit, right? But you've picked up some details on how Paytm may not enter insurance.
Well, that's correct. So, of course, Paytm as a company has been looking to diversify into other streams of financial services business. Insurers was one of them. Initially, they were trying to acquire this existing entity called Raheja QBE. That didn't work out. After that, they were planning to acquire their own insurance license, which for different reasons also did not work out. And the latest that we've been given to understand from our sources is that Paytm has dropped its plan altogether to enter the insurance business. In fact, not just that, we're also picking up that Paytm is right now not looking to enter any other lines of financial services business apart from the existing ones. The focus, as per our sources, will be on payments and credit disbursement. But of course, insurance was something which the market was very keenly looking at for Paytm, as they were very actively looking for a player or a license. That does not seem to be happening now, and the plans for insurance venture have been dropped at Paytm.
Okay, well, they continue to distribute insurance products, so they're a distributor, but no plans to sort of manufacture products themselves, as Yash is telling us. Okay, well, let's Paytm for you, but oil prices have been on the boil, almost $91 a barrel. Manisha is here with the latest. Manisha, morning.
Thank you for that, Prashant. Well, yes, Saudi Arabia and Russia cutting output and exports until December end is what the markets were reacting to yesterday. Today, it has been about the API data, which suggests that the U.S. crude inventories have declined by 5.5 million barrels in the previous week there. Well, remember, this is also the U.S. hurricane season, and we have seen those disruptions in Gulf of Mexico. Also, with the kind of output cuts that Saudi and Russia have put out, markets are now getting worried about the winter demand estimates. I mean, that would start hitting us by the month of November and December as well. So that is keeping the premium on for prices. Charters do tell us that the crude prices are overbought because we've seen prices gain up by $8 in the matter of 2 weeks. But with the kind of momentum that the markets have right now, the street also expects that you could be looking at $92, $95 a barrel coming in the month of September itself.
All right, thanks a lot for that, Manisha. Well, here's a quick recap of our top stocks in case you missed out on any of them. Stocks with positive news flow. There's TCS, Shriram Finance, Dreamfolk Services, JM Financial, NRB Bearings, Biocon, Biologics, Paytm and ONGC, while stocks with negative news flow today, there's PG Electroplast and Tata Consumer. But there are plenty of brokerages that have released interesting notes this morning. Sonal is here. She's compiled all of those notes for us. Sonal, good morning.
Good morning, Sonia. Well, interesting notes that I have read this morning. Well, starting with Jubilant FoodWorks, that stock was buzzing in last two trading sessions that possibly the World Cup demand could come back, and that is the reason why there could be better growth as well. But Macquarie says that that could not be the case. They have an underperformed rating with a target price of 330 rupees a share. They say they did not see any benefit of World Cup related demand in 2019. So whether that will convert into demand in 2023 is something that they'll watch out for. There's increased competitive intensity from peers, which is raising the risk of same-store sales growth benefit that will be muted this time around. There's uncertain demand outlook. Investments are needed to ramp up their dine-in as well. So a cautious tone coming in from Macquarie for Jubilant FoodWorks. CLSA has written on all the EMS companies. They have initiated coverage there. They are overweight on the sector. On Amber End, there's a buy rating with target price of 3650 rupees a share. On Dixon Tech, it's at 5675 rupees a share. On Keynes, it's at 2,230 rupees a share. And they expect India's EMS industry to deliver a 22% revenue CAGR. This is over the next decade. So they are very positive on the sector as a whole. Interestingly, Kotak Institutional Equities has also initiated coverage on Dixon Tech at a sell, and they have a target price way below the current market price at 4,000 rupees a share. Though they are positive on the prospects going ahead, they say companies transitioning away from slow-growing segments and where it has a large 30% plus market share to new EMS segments, to exports, to competent manufacturing as well. They expect Dixon to generate good operating cash flows around 1,900 crore rupees to 500 crore rupees over the next financial year. But valuations is something that is keeping them in check as well.
That's interesting. That Kotak sell is a big sell. They're calling for 4,000. The stock is at 5,000 right now. Interesting clash between bulls and bears on Dixon. We'll take a break on that note. Thank you very much, Sonal. We'll come back on the other side, and Dipan Mehta of Lexer Equities joins in. We'll talk about some fundamentals. And we'll also connect with Aditya Khemka of Incred Healthcare PMS to talk about the demand trends we're seeing in the pharma sector. Well, as we've been saying, there is a hint of caution in global markets. It is that sort of a day. By the way, a lot of the Asian markets are down quite a bit. The Kospi is down 7/10. Hong Kong is down. Australian markets are down. So most of Asia is also fairly negative. That's the picture. Let's actually talk about some more stocks that could be in focus. And there's some chatter about L&T picking up a very large order from Saudi Arabia. Vivek is joining in. Let's ask him about this one. Vivek, good morning. What are you picking up?
Well, good morning. There's been an article from an Middle Eastern journal which states that L&T, which had participated in the bid for Saudi Aramco's Jafurah unconventional gas development project. So L&T has been selected as, the preferred contractor for a contract worth $2.9 billion, which translates to close to 24 to 25,000 crores. So even for the size of L&T, this particular order win is quite significant, and it's a very large order win. What will L&T do? L&T will develop the gas processing plant and main process units for this particular project. And another interesting development is the fact is that just a couple of days ago, there was another package that Saudi Aramco has floated. The total value of the package is close to $10 billion. This is for Safania gas field. This also is underway. Bids were submitted recently. It remains to be seen, whether L&T does get any particular order win from this particular bid as well, and what will be the size. But the current order win that has come in at close to 24 to 25,000 crores is a significant order win. It'll be interesting to see how the stock takes this.
Okay, thanks a lot. As they say, right, when it rains, it pours, and it's pouring orders now in the capital goods space, and you're seeing it in the stock as well. I mean, L&T has been one of the biggest gainers this year. Just pull up a one-year chart. It's already a 25% gain that L&T has seen. Dipan Mehta, director at Elixir Equities, is joining us now to give us his view. Almost a 40% actually in the last 12 months. Dipan, your thoughts here? There is clearly a revival in the Capex cycle, and now you're seeing orders pour in thick and fast, not just from the government's end in the domestic market, but now on the export front as well. Is it too late to jump onto this bandwagon?
Good morning, Sonia, and thank you for having me on your show. I think if L&T gets an order like this, then certainly it's not too late. And the thing about L&T is that, they have been focusing a lot on return on capital employed, and that certainly has improved the valuation ratios, a lot of value being created in the subsidies as well. But on the whole, I think we were a little cautious on the market. But at corrections, I think capital goods still remains a very sustainable investment theme. And many companies over there are sitting on 2, 3, 5-year type of order book position. And that does give very good visibility, and valuations are still reasonable. And what I like best is that eventually all of the operating profit margins for these companies also will start to inch up because of operating leverages or because of higher margin orders and completion of legacy orders. So I think next 2-3 years, the earnings growth will be fantastic. I would say 25% thereabout for a whole host of companies engaged in capital goods supply or services, or even EPC projects for that matter.
Okay, well, there is L&T. Deepan, hi, good morning. Prashant here. So many sell-side reports on this entire EMS space. I think CLSA has got a note out this morning, I think. Jefferies had a initiating coverage note out 2 days back. Ambit has put out this morning something on the space again, saying, well, they're moving away from assembly to more value-added efforts across the board. Dixon and Amber and Keynes and Sirma and PG Electroplast. Stocks have all, the runway for growth may be pretty long, but prices are also pretty high here. So what's the bet to make if you wanted exposure? If you don't have exposure and if you wanted to get in, is this the right time, or one should just wait for some dips whenever that happens?
Good morning, Prashant. See, the thing about these EMS companies is that they keep on surprising on the upside. You see, there have been minor setbacks for Dixon, but the numbers last quarter were pretty decent. And these are great secular stories. If you hold them for even 1 or 2 years or so and price goes lower, suddenly you find them at very attractive levels. And then from that point also, these companies can generate 15-20% type of bottom line growth. So if you have a 5-year, 7-year, 10-year view on these companies, then even from these levels, you will see them compounding really well and delivering above average returns. But that, I think, considering the valuation at which they are trading at, yes, I think some sort of a correction can be expected in them. A bad quarter will lead to unusually higher correction in the stock price because a lot of expectations have got built in. Also keep in mind that floating stock is very low. The likes of Dixon or Amber, they are favorites with a lot of portfolio managers and small mid-cap funds as well. And part of the reason why they are trading at such rich multiples that whenever fresh money comes into these investment vehicles, they are buying the same stocks, which include these two companies per se. So just because they're expensive, I don't want to sell. But I think that at correction, one could look at entering into these companies, but you have to have a longer term view, 3 to 5 years or so, because that's where I think the maximum returns will come back-ended, in my opinion.
Okay, all right. Dipan, just stay on. We'll come back to you. We have many more questions for you, especially in the pharmaceutical space and what's been happening, with all that talk of Cipla and Torrent, etc. In fact, Aditya Khemka, the fund manager at Incred Healthcare PMS, joins us now to talk about that. Aditya, the last couple of days has been spent in analyzing what happens once Torrent Pharma acquires Cipla, if and when that happens, right? So the news is out there, but you tell us, what is your prognosis? And what's the way forward for retail investors who hold these shares?
So look, good morning and happy Janmashtami to you and your viewers. So if Torrent were to acquire Cipla, first of all, the report isn't confirmed and we don't know if this is going to happen. So as investors, the first thing to look out for will be, at what price do they acquire it? Generally, companies end up paying a premium to the current market price of the stock which they are acquiring. If that is the case for Cipla, in our view, it might be tough for Torrent to justify that acquisition given the valuations that stocks like Cipla are at today. And to give a premium to that would be a very, very difficult sort of situation to show value for the acquisition. So that is number one. Number two, such a large ticket acquisition, Torrent does not have the cash to do that. So either they will part dilute equity or they will, they will do the acquisition with equity and cash. And for that, they will have to dilute, the promoter will have to dilute, the minority shareholders will have to dilute, or they will take substantial debt, which again puts a stress on their P&L and, everything. So we don't know whether it's going to happen, but if it does happen, it's a deal that, will be a transformative deal for Torrent Pharma. And if it's done at the right valuation, if there is the right amount of synergy that they're able to extract, it can be a very, very big positive. And at the same time, if the valuation is not right and the synergies are not enough, it can be a big negative as well.
Aditya, sorry, just a very basic question. Have we heard from Cipla themselves that they are indeed going to sell, that they will sell? Have you heard it? Because there are so many stories about who all is in the race to buy. But go on.
Yeah, look, so my understanding is that, and this is purely my understanding, Cipla hasn't made any official statement or unofficial statement on this side. But my understanding is that Cipla has a succession issue. Yusuf Hami, is now significantly out of the game. He's more of a mentor. He's not actively managing the company anymore, and there is no succession plan. In fact, if you look at India, many companies that started in and around the liberalization era, the first generation entrepreneurs will be exiting the businesses now, and you'll have this kind of probably things happening in multiple companies now in the next few years. Because these entrepreneurs would have been working for 30, 40 years now. And, if the second generation isn't interested in the business, they will have to sort of encash what they have built over the last 30, 40 years. So Cipla may be a classic case. I think if you think of Cipla as historically, Amalullah used to run the business till 2011. Then came Subhanu Saxena, an external hire. Amalullah himself was an external hire. And then, Umang Vora now, who came from DRL to Cipla. So clearly, succession planning isn't there, and it just may make sense for the Hamid family to cash out at this point in time, especially when the sentiments towards the business is very positive, the stock prices are fairly rich. It's a good exit point.
What's your, Aditya, hi, morning. What's your target price on Cipla?
So look, we are an EMC, we don't issue research reports, and therefore we don't have target prices.
My bad. Sorry for that. Let me ask you about something else. I mean, in case you have any thoughts on this, because this is a very different company and a different development in the pharma space. I don't know if you've seen what's been happening around InSwift Labs, and that's getting a lot of attention. The company yesterday decided to, sell off 96% of its business. I think the entire API business, CRAMS business, got sold off. They're getting over 1,600 crores of it from the sale. But then they're, pushing 600 odd crores into a separate group company, which they say they will, I think, merge with InSwift later or something. It's pretty complicated. And the stock has been going through the roof. So it would be highly confusing for a lot of investors or even, people who are watching on the sidelines wondering what should be done or, what to make of it. What's your sense?
So it's very difficult for me to comment on what InSwift is thinking because, we haven't heard from the management anything official. So very difficult to understand what they wanted to do when they sold a large chunk of the business. And when they are merging with a private entity, generally, we avoid looking at companies where the promoter is merging a listed entity with a private entity of his, because then there are conflicts of interest that needs to be looked at. Having said that, end of the day, India has many sick API companies. These API companies became sick over the last 4 decades because of the intense competition we had from China. And now, at this stage, we have some of these companies that are doing Capex and trying to grow, and some of these companies which are basically trying to sell out because the sentiments towards the API business in India is improving now. So InSwift seems to be a case of the latter, where they are exiting the business. And then what the promoter decides to do with the cash and merge or not merge, I mean, that's something that we haven't really had any color on.
The stock of the year, I think undoubtedly in the pharma space has been Aurobindo Pharma, right? I mean, it's almost doubled this year. And what's going so right with the business, A? And B, there's a lot of talk about the company exploring possibilities of restructuring their Eugia Pharma business. What do you think the prospects of that look like and what's the way forward?
So look, Aurobindo Pharma's majority business is the US generic business. What we have been hearing from other sell-side research firms is that the business is slightly stabilizing in terms of price erosion, so which used to be double-digit last year, is somewhat mid-single digit this year. And I think Aurobindo, being one of the largest companies in the US generic space, is a leveraged play on that. So it is not surprising that the stock has doubled because, or gone up even more than double in the last 1 year, because the stock had fallen very significantly. So if you look at a 5-year return on Aurobindo stock, I think it's 0%. But if you look at it from the last 1 year, yes, it has doubled. So the time frame really matters. What I have been saying all along is that the US generic business is a very commodity business, and you have to pick your entry exit points. You cannot stay invested in this business. It cannot be a structural story. So 1 year back, maybe it was a great price and a great time to get into something like an Aurobindo. Today might be a completely different story. So we feel that the US generic business is continuing to be very, very competitive. The price erosion is still there, even though it has moderated, but it is still there. And there are a couple of large products that these companies have launched, like Revlimid, etc. But those are temporary cash flows. So if those temporary cash flows get a multiple of 15, 20, implying that these cash flows will last for 15, 20 years, then it's a ticking time bomb. At some point, it will explode.
Aditya, just to wrap this up, just tell us what are your top ideas in the healthcare, in the pharma space, actually pharma and healthcare, hospitals.
Sure.
Go on.
Sure. So I run the Incred Healthcare PMS fund. So I will give you the top 5 picks that we hold in the fund. Our largest pick today is Jubilant Pharma. That's a company which is engaged in the diagnostic ancillary industry as well as API industry. Our second largest pick is RPG Life Sciences, which is a domestic branded formulation business. Our third largest pick is Krishna Diagnostics. It is a diagnostic player in India, B2G. Fourth largest pick is Thyrocare, which is again a diagnostic player in India, B2B, largely B2B, some element of B2C. And our fifth largest pick is HCG, Healthcare Global, which is a cancer dedicated hospital in India.
So in this hospital space, there are a couple of new listings and there are new IPOs as well, like Jupiter, right? Jupiter Lifeline. And of course, this space has picked up in a big way. You think there's a lot more scope despite the kind of rally that we've already seen?
That would be very stock specific. To be honest, some of these stocks I feel are priced way beyond what growth they can deliver. And some of the other stocks are relatively very underpriced. So the space as overall seems fairly valued, but there are stocks on one end of the spectrum and there are stocks on the other end of the spectrum. So you have to be selective into what you invest in.
Okay, got it. Aditya, great speaking with you. Thanks a lot for providing clarity on this entire sector and what you should be watching out for. That's Incred with a view on the healthcare space, which has undoubtedly been one of the big spaces to watch this year. Well, let's move on now. Looks like it's going to be a start which is slightly sluggish, but Anuj is joining in now in his festive attire, celebrating, of course, Janmashtami. Anuj, happy Janmashtami to you, entire team at Aavas. But how is it looking? I mean, there's cues which are providing a little bit of a headwind for the market now.
Morning, Sonia, Surabhi, Prashant, and to all our viewers and to all of you, happy Janmashtami.
To you too.
The one significant lesson that you take from Sri Krishna's life is that life's meaning is in struggles, and you let the outcome to God or destiny. You do your process and let the outcome be decided by God or destiny, and just focus on that. And that's what if you've done in the market has rewarded you actually. All through the September series, the numbers would come up for you. Again, Sonia, I just said the cues might be bad, but cues were bad yesterday as well, and we closed at highest point of the day. Now look at what the Nifty's low has been. Consistently rising, 19,255, 19,432, 19,525. Yesterday was almost at the same level, and the high has also been going up. The close rather, 19,435, 19,529, 19,575, 19,611. All 4 days, if you bought intraday, the markets rewarded you. And if you carried your positions, you made money. But the problem is the Bank Nifty. Look at Bank Nifty's close over the last 4 days. The Nifty has gained about 400 points. The Bank Nifty has been absolutely flat this series. It started at 44,436. Yesterday, we were at 44,409. And the key differential between the Nifty and the Nifty Bank has been the Nifty IT. Let's look at what Nifty IT has done now. And this is Nifty IT's high and low. Look at that differential. From 31,550, we've gone to 32,515 on the high. And from 31,100, we've gone to 32,000 on the low side. So that really has been the index to track for last few days. Now, coming to today's trade, and just one more number that actually tells you the significance of why Nifty is outperforming versus Bank Nifty. Look at what FIs did in index futures yesterday. They bought 500 crores in Nifty futures, but they sold 538 crores in Nifty Bank. Now, of course, we get individual data points for both indices. The Nifty outlook for the day, first support at 19,491, yesterday's low, and the bigger support 19,423, the 20-day moving average. The Bank Nifty, first sign of life in HDFC Bank yesterday, but and with some delivery buying, but most of it was negated by ICICI Bank. I think you still want to avoid Bank Nifty, see how it's moving, perhaps breakout or breakdown, do one of the two things, and then take a call on that. For now, it's still in a broad range of 44,300 to 44,800.
Okay, well, Anuj, thanks very much for that. So that's basically the setup as we are looking at it. We'll take a quick commercial break here. Mitesh and Sudarshan are going to be with us with their specific technical trades that's coming up here on the program. There's 11 minutes to go for the pre-open session. Stay with us. Okay, well, there's Chinese data at the bottom of the screen. Imports in August in China are down less than expected, 7% compared to a 9% fall, and some other stuff coming through. This is, I think it seems prima facie to be a little better than expected. But more on that as we go along. Mitesh and Sudarshan are with us with what they're making of things. Gentlemen, good morning. Good to have you guys here. Mitesh, so, you know, again, a recovery from the lows and a solid 100-point recovery. How are things looking this morning, and what would you do?
Morning, Prashant. A good recovery, and also I think, you know, with that we nearly managed to meet the upside zone, which is around 19,680, 700 area. We've started taking profits off, waiting for some dip to enter. But once we start getting past 19,700, I think that's an event, you know, which will get me excited and make me more aggressive on the long side. So for the time being, let's treat 19,700 as a key hurdle. Till that is crossed, I think trade with some caution on the indices, though individual stocks can keep performing, and use declines to buy into the index till then. And on a move beyond 19,700, that will be a breakout, and buy aggressively then with a 70, 80 point kind of a stop loss. I'm still avoiding the Bank Nifty. I believe it remains an underperformer.
Prashant, you know, I checked the other number as well. Both imports and exports, the data is better than estimated on both fronts. Both imports and exports are down, but less than estimated. Imports are down, I think, 8.8%. The expectation was it was a 9% plus fall. However, the Hong Kong market's fallen more. It's taking no heart from this. In fact, the Hong Kong Hang Seng is now down 1%. Maybe they have other issues, property market, still a big trouble spot in their minds. So that's just an update on China, the data that has come through. Sudarshan is also with us. Sudarshan, morning. How would you look at things today, considering that global cues are not very supportive? We've been in a range. Nifty, Bank Nifty, what would the trades be today, if at all?
Oh, my trades are, my suggestion is the same as yesterday. Wait for 200-point dips before entering the Nifty. The Nifty is still a buy, but it needs to correct or consolidate, one of the two things. In either case, we'll get 200-point dips approximately. So I'm not a buyer at the open of the market. The market needs to go down for me to go and enter it. Now, sometimes it doesn't happen, which means the Nifty can simply go up. It doesn't really care about what I think. In that case, I missed this particular trade. I am a buyer only on a dip. The Bank Nifty is a complete avoid. The very choppy nature of the rally, ups and then big downs, then sharp upswing, then again sharp downswing, that's not comforting. So the trade is still on the Nifty, only on a sharp dip.
All right, the trade is still on the Nifty. So Darshan, what about on individual stocks and also on the Nifty IT index? It's at a 52-week high. We've discussed this ad nauseum, but do you see more upsides here? And are there any stocks to pick in this universe?
Well, yes, the ID index has more upside here. If you are an investor or a position trader, I can't time it for on a day-to-day basis because it's been a big rally. So anytime a small correction can come. But for if you're looking to say for a 6-month time horizon, even at these elevated levels, the IT index is the buying opportunity. I always talk about the blue chip stocks in the IT index. So it's very really TCS and Infosys. Just focus on them. Leave Midcap IT aside. Bajaj Finserv is a buy. The stock, put a stop under 1480. The stock is making a very attractive bullish pattern after a decent decline. Britannia is a buy. It was Colgate yesterday, so something is happening to the FMCG sector after big corrections. It's a buy with a stop under 4420. Cipla is a buy after a big rally. The stock has been consolidating. Such consolidations are expected to break on the upside. Buy with a stop under 1200. And finally, my last pick, SBI Cards is an intraday short. The stock is in a bear market which persists. Intraday short with a stop above 840.
Okay, all right.
All right, Sudarshan, thanks for those picks. Miresh, let's come to you as well. Stocks for the day?
Morning, Surbi. I have all buy calls. Amongst the sugar space, Balrampur Chini finally appears to be triggering some kind of an up move. So buy here with a stop at 406. The first target is around 425. I suspect eventually higher levels could be tested. A buy on IEX with a stop at 132 for targets of 147. Amongst the FMCG pack, I have picked up Marico, I think, on the verge of breaking into fresh highs. That's a buy with a stop at 580 for targets of 610. And a buy on Naveen Flori with a stop below 46.25. I would recommend targets of around 48.20 here as a trading area.
All right. Well, thanks, gentlemen, for that. Let's do one thing. We have about 3 minutes left for the pre-opening rates to kick in. So we're going to take a quick commercial break. We'll come back with the pre-opening rates. We'll also have Jinesh Joshi of Prabhudas Leeladhar to talk about the much-awaited release of the SRK starrer Jawan that hits theatres today. PVR has definitely been the MVP stock of the last 1 month. More on that coming up. The global cues are not that supportive today. Most of Asia is under pressure as we speak, and our own markets also look like they're not going to get off to a good start. But let's see. This has largely been a buy on dips market. So let's pose that question to Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, hi, good morning. Would you buy this dip if it comes about in a large way? And what are the individual stocks to look at today?
Good morning, Sonia. Thanks for having me. Wishing a festive time to everyone. So looking at the market, we have seen good recovery in the Nifty in last trading session, especially in last 1 hour. And the strong part is that the base of the index is shifting higher while Bank Nifty and other heavyweights are moving in a range. So as of now, the buy on decline stance could continue. If any declines comes to us, 19,500 zone, that could be utilized as a buying opportunity. As of now, we are expecting Nifty to move in between 19,400 to 19,700 zone. So buy on decline could continue here. Looking at the data setup, India VIX is falling down. The volatility is down from last 4-5 trading session, and put call ratio is near to 1.32. So holding put call ratio with falling volatility indicates some sort of support will be there in the market. But if I talk about the bank nifty here, the picture is slightly different. We are totally stuck in a range. It is flirting near to its 50-day exponential moving average. And from last 10 trading session, we are moving in between 44,000 to 45,000. So if weakness is there, that will be more in the bank nifty, while nifty could be buy on decline stance as of now. But the good part is that in this market, we are witnessing good stock specific actions, whether we talk about FNO and non-FNO counter. So let's talk about the stocks. First, that is buy on Indian Hotel. This stock has seen 95% rollover from previous series to current series. Pollen flag pattern breakout is clearly visible. Base of the counter is shifting higher. We have seen some sort of put tracking activity. So recommending to buy on Indian Hotel with a stop loss of 423. It can head towards 452 kind of level. Second trading idea, that is buy on Escort. Measured trend of stock is positive. It has seen a consolidation of last 5 days and now all set to start the next leg of rally. In last 4-5 days, we have seen 37% open interest and OI is up from 12x to 17.5x shares, which clearly indicates about the long accumulation. So expecting fresh rally in the counter towards 3,300, one can buy with a stop loss of 3,100. So last trading idea, that is buy on McDowell. We have seen huge open interest addition of around 13 to 14%. It has given a consolidation breakout of last 30 days. And that consolidation supports are also shifting higher, which indicating fresh leg of rally in the counter. So one can buy with a stop loss of 1,042 and McDowell or United Spirit can head towards 1110 on the upside.
Okay, got that. Thanks very much, Chandan, for all the details there. Good having you on the show. As usual, you have a good trading day. Well, let's get back to our conversation with Dipan Mehta. Dipan, hi, good morning. One brokerage note that caught my eye today was CLSA getting all bullish on this EMS space, electronics manufacturing services. And I was wondering whether they're coming in on this a little too late. But anyway, CLSA's thought is that this is a multi-year story. Want to get your views. I guess it's a question of valuations as well, right? Because some of these small little stocks, Keynes and Sirma, etc., some of them are trading at 50, 60, 70 times already. So how would you view this?
Morning, Surbi. You're right. They got both of it right, that they are entering a bit late into this space by giving out a recommendation. And these are, in fact, multi-year secular growth stories. And, typically when such an investment theme plays out, you don't know what the outcome can be. Because, we are working with present facts, but the environment is so ripe and there are so many opportunities and so many players, internal as well as MNCs looking to manufacture into India. So the opportunities, I think, are not completely visible or perhaps captured in the stock price. We are looking at their trailing 12-month earnings per share and just compounding it by 25%. And then extrapolating what it will be for the next 2-3 years or so. But I think these earnings can surprise on the upside. But till then, I think the stocks will run up significantly along with a lot of mid-cap stocks. And I would like to buy them at a correction. Maybe 15-20% correction can happen any point of time. A bad quarter also can lead to a correction. So buy at decline is my outlook for all these EMS stocks.
Divan, just one quick one. Yesterday, actually, in the broader market, it was very peculiar because what went up was a mix of smaller sectors. So I'll tell you, sugar stocks went up. Right? I counted some 10, 13, 14 sugar stocks which were up. Big gains, by the way. And we'll put some of them up. Renuka, Dhampur, Dalmia, Ugar, Mavana. Second day running, by the way. Sugar has been moving up. You had fertilizer names which moved up. Again, smaller sector, right? RCF, Madras Fertilizer, FACT. And these are not areas where only one stock moves up. It's usually a sectoral move. Third sector, paper. Again, it's a sectoral mover, not a single stock mover. JK Paper, West Coast, Andhra, Tamil Nadu Paper, Orient Paper, you name it. Was all the rage yesterday. Rice stocks moved up. Dawat, KRBL. So these are, and by the way, this is the bulk of the broader market move. The big volume-led movers in these are from these 3-4 spaces. Apart from, Sirma, Avalon, the EMS stuff that we were discussing earlier. Anything in this space that you like? And I just want you to comment particularly on sugar. Is the excitement justified? Because global prices are rising, sugar prices, but it's very unlikely that retail prices will be allowed to kind of, rise significantly here. Manisha yesterday was telling us that local prices are at about a 35% discount to global prices. Go on.
See, Prashant, the common thread across all the sectors you named is that they are low PE stocks. And in markets like this, I think value investors are migrating to these counters where there's still comfort as far as valuations are concerned. Specifically, sugar, I think they did well because sugar crop may be lower and therefore prices may be higher, and companies sitting on stock from last season may benefit from that. But nonetheless, these sugar companies are deriving more and more revenues from ethanol, which is quite profitable. 30-40% revenues coming from ethanol for many of these sugar companies, and that's rising at 25% thereabout because of the government mandate to blend it with petrol. So I think prospects are great for sugar companies. The return ratios are also pretty decent, and all of them are expanding capacity, especially in the ethanol side. So very positive on sugar companies. I would say that any of these companies, Balrampur Chini, all of these companies, I think, could offer an outperformance, and they're available at reasonable valuations. You could include Dhampur Sugar. All of them are doing pretty well at this point of time.
Okay, thanks a lot, Dipan, for joining in. Appreciate your time. We're heading into the pre-opening rates kicking in for the market, and it's not bad, to be honest. The Nifty is absolutely flat. There are plenty of stocks, actually, ONGC, NTPC, Britannia, Bajaj, Finserv, that are gaining from the front. But let's discuss the big event upon us. For all you movie buffs, Shah Rukh Khan's Jawan finally hit theatres today. In fact, as of September 5th, the movie Advance collection surpassed 25 crore rupees and expected to have a big bang opening. Any of you planning to watch this one? I didn't even watch Pathaan, so I don't think I'll watch.
I didn't watch Pathaan, and I have such a huge backlog. I mean, all the good movies.
Oppenheimer, Barbie.
No, Oppenheimer I watched thanks to Prashant telling me it's an unmissable one, and I watched it in the theatres. I wouldn't mind watching it again, I must say. But then Barbie, forget it. It's not happening. A lot of other Hindi movies that are still on my list.
I booked tickets, by the way, for my third viewing of Oppenheimer, and I cancelled it.
Prashant, can we bow down to you?
Prashant, move on from Oppenheimer.
Christopher Nolan should come with a trophy.
Saturday, because I have to. Anyway, my daughter wants to watch it again.
The world has moved on from Oppenheimer to Jawan. So
by the way, you guys missed Equalizer, Denzel Washington. That's going to be. I think that's also running.
I think I should get all my movie tips from Prashant.
Okay, but let's pose this question to Jinesh Joshi, because the stock of the moment and the stock of the last 6 months has been PVR. It's gained almost 30% in 6 months. It's at 1800 now, 1850 actually. Jinesh, thanks for joining in. So the hype is real, right? I mean, box office collections are expected to hit record levels. But the stock, how are you positioned there?
If I talk about the stock and the quarter per se, in the August month itself, the footfalls for PVR were at about 1.9 crores. And on a very conservative basis, even if I assume a 1 crore kind of a number for July and September, you will be somewhere at about 3.8 to 3.9 crores. And if I compare this with their best ever quarter, which they reported in 1Q of FY23, wherein they were at about 4.3 crores, I think you are off by about 8 to 10%. So definitely this is going to be an exceptionally strong quarter for them. And we maintain our positive bias on the company, and we favor multiplexes even at these levels.
Jinesh, jog our memory in terms of valuations over the last 10 years. What was the peak for PVR before the pandemic hit? And now that content is coming back in a big way, it's very clear that people are willing to go back to the theatres. That's what the last 2-3 months have proven. So therefore, what are you expecting in terms of multiples significantly moving higher from here? Do you see that as a possibility?
Definitely, that can be a possibility. If you look at PVR currently, we are expecting a pre-Ind AS EBITDA of approximately 1,300 crores for FY25. And on that, the stock is at about 15 times. Historically, it has traded at an even higher multiple. And as I mentioned previously, with the content being exceptionally strong in this quarter, and Jawan's advanced booking numbers also, raising the hopes, we do not see, we indeed see a re-rating possibility even from here on.
15 times EV to EBITDA right now.
Sorry, I did not hear you.
No, I was just clarifying the valuation multiple. You're saying it's trading 15 times EBITDA.
Yes, pre-Ind AS EBITDA 15 times FY25.
Oh, wow.
Okay, and what is the expansion that you think is realistically possible? 15 times going up to what?
Maybe I think 10-15% from here on, which should be at about, say, 17 odd times, 17-18 times. I do not recollect the exact peak, but given how content has behaved, I see some re-rating happening in multiples even from here on.
Oh, some de-rating in multiples. Okay. We're talking about the box office collections, right? I mean, experts believe that it could be a 100 crore opening for Jawan this time. So that will be, of course, spectacular for PVR. But can you tell us how have the collections been in Q2 so far? I think on an average in the preceding 4 quarters, there have been box office collections to the tune of around 1,000 crores or so. Has it picked up substantially in the last few quarters? And what does this mean for the earnings for PVR?
Sure. So if you look at last 2 quarters, I mean, the industry-wide box office collections have been in the band of about 1,800 to 1,900 crores, if my memory serves me right. And if you look at the first 2 months of this quarter, I think the collections have surpassed that levels. So definitely this quarter we'll see a healthy collections on the industry level, and this would obviously benefit PVR, because if you look at PVR's share in the industry box office collections, historically it has moved in the band of about 30 to 35%. So definitely a good sign for PVR and multiplexes.
Jinesh, do you track Z?
Yeah, I do.
And what are your thoughts there? Because I think the case comes up tomorrow in NCLT, right? In front of I think it's a SAT, which will hear it again for the continuation, the appeal to allow Mr. Goenka to continue with the company. So a lot of people are watching that very closely. Stocks moved up recently. Go on briefly.
Yeah, see, I think with the NCLT approval coming in, the SAT verdict, I do not think that holds too much value right now. And also, if you kind of look at Mr. Goenka's commentary earlier on, he had clearly mentioned that the prerogative is for the merger to go ahead, irrespective of what happens to the incumbent position. So I do not see that as a major risk. In fact, I mean, even if the NCLAT approval on the IDBI side also comes through, and if Z is made to pay, they might as well pay that amount and just find a rescue option over there. So with merger now going through and all approvals being in place, I think the street will look at what the company can deliver in terms of FY25 PAT, given the fact that $1.6 billion will come into the company, and they also have a sports exposure right now. So it becomes a good package to look into.
Okay. All right. Got that, Jinesh. Thank you very much for joining in on a bunch of media and consumer-related themes, including, of course, Z and, of course, PVR. Thanks for joining
apart from PVR, a smaller thing which became very big recently, the hottest thing I would say this week, which has happened in media, and is a company called Basilic Fly Studios. They launched an IPO. They wanted 66 crores. This is an SME IPO, and they got bids worth 10,000 crores.
Wow.
This is just, I think 2 days back. So... but it's called
Basilic. Not extra zero somewhere.
SME Exchange.
SME Exchange, but they're involved in movies like Avengers and lots of other. So yeah, absolutely crazy.
Phenomenal stuff. Yeah. 10,000 crores. Oh, that's quite some appetite. Very quickly, let's get Mitesh's call in before we hit the opening bell. Mitesh?
Yeah, I'll go with a buy call on IEX. Keep a stop below 132 around that level, and 147, 150 is the target.
Okay, well, let's discuss some more stocks now. RBL Bank is one of the stocks on our radar. Abhishek is here to tell us more about that. Abhishek?
Well, Sonia, Nirmal Bank has written on RBL Bank. They have a buy recommendation, target price of 270 per share. There was a conference update which they have mentioned that improving share of retail asset is seen, and liability mix is a key focus of the bank. So bank continues to maintain loan growth guidance of about 20%, which will be driven by 20-25% in credit card and MFI portfolio. So share of wholesale book will decline from 44% currently to about 30-35% by FY26, and all new businesses are expected to achieve break-even positive and about ROA positive by FY25 end. Net interest margin is expected to remain at 5% by FY24 and above 5% as liability profile improves. So they expect the bank to achieve ROA of 1.2% and ROE of about 10.9% by FY25 end, and that is why they are bullish on the stock. Back to you.
Okay, thanks a lot for the timing, by the way. Just in time for the market opening, Abhishek. So we're heading into the market opening in 11 seconds. Looks like it's going to be a flat opening, which is not bad, actually. Given the kind of cues that we have, given the way global markets are under pressure, a flat opening is something that the bulls would take with both hands, and there it is. In fact, the mid-caps and the bank nifty are actually have started a tad bit in the green. So let's see how it goes from here. Nifty absolutely sideways this morning. That's the first tick. now down about 20 odd points, but still hanging on to that 19,590 mark on the index. What's leading from the front is TCS on the back of that JLR order win. So TCS is up about 0.3%, ONGC, Maruti Suzuki, Kotak Mahindra Bank is picking up a little bit of pace. Dr. Reddy's, Tata Motors, Bajaj Finserv, HDFC Life, a couple of other stocks that are in the green right now. On the downside, Tata Consumer Products, we've been discussing that, on that whole Haldiram acquisition piece. So Tata Consumer down almost about 2% on the denial there. JSW Steel, Power Grid, Hindalco, LTI Mindtree, Apollo Hospitals, a couple of other stocks that are just about trending in the red. But suffice to say that this is a market that has opened absolutely flat, little bit of a negative bias, nothing alarming. In fact, the advance decline ratio is still trending in favor of the advances, about 1,300 stocks on the advancing side on BSE, compared to about 550 stocks on the declining end. So given the kind of subdued global cues, this is not a bad opening at all.
I guess it's a lot better than what we've seen across Asian markets. So the bulls will take this. Look at the way these EMS stocks are flying on that CLSA report. Keynes is up 8% straight away. I think CLSA's price target on the stock is somewhere around 2,200. It's already reached over 2,050. Amber is up 5%. Dixon is actually flat because in Dixon, Kotak has a contrary view. Kotak has a huge downside target of 4,000 on Dixon. So classic bull versus bear between CLSA and Kotak Institutional Equities playing out on Dixon as we see things. Paytm, Yash was telling us that sources are indicating they won't get into insurance. The stock is down about 0.5%. On Jubilant, there are some negative reports. I think it's Macquarie saying they're not quite convinced that this World Cup is going to bring so much of excitement and heightened consumption for Jubilant. That stock's slightly negative. In Swift Labs, it is literally the curious case of In Swift Labs. It was up 20% on circuit yesterday, announcing pretty much the sale of their entire business. Today it's down about 11%, so absolutely chaotic moves on that stock continuing. Beyond newsmakers, let's look at what else is catching the attention this morning. Some of the fertilizer stocks are still running. There were an active lot yesterday as well. Nagarjuna Fertilizer, for instance, up about 4%. Good volumes there as well. GMR Power, 3% on the upside. IRFC is at it again. 4% on IRFC. It took a break yesterday, bit of a breather. Back on the upside of the screen today. Lemon Tree Hotels, Castrol India. These are some of the other names where the gains are coming in quite quickly. Watch out for CG Power as well. Interesting move on CG Power, about 3%. We keep talking about, of course, a lot of action in the power space. That's a stock on the upside. Devyani, by the way, is up. Jubilant is down, but Devyani is up about 3% when we speak of QSRs. Interesting market, I guess. It's still down on the Nifty, 20 lower. But as usual, mid-caps have a mind of their own.
So is it like people order more burgers and less pizzas when they watch cricket matches? Is it like that? I mean, why is Devyani up?
But Devyani is up, so, not quite sure. But I think the expectation has been that as you get into the World Cup, people will go back to ordering QSRs. One of the brokers today are arguing, saying that you have Zomato now, so you have plenty of options.
You have plenty of options. You don't have to stick to the listed QSR space. But I think the space to be in this morning is the EMS companies, right? So whether it's Keynes Technology, whether it's Amber Enterprises, Dixon, all of these stocks. CLSA, of course, put out that note. Our colleague Sonal was telling us about that. Not Dixon, but Keynes Technology is, CLSA is very positive on this stock. That's 7% higher. Dixon also, CLSA has initiated an outperform, saying that the Indian EMS industry is expected to deliver a 22% revenue CAGR over the next decade. So even Amber Enterprises is the one that's looking good. Varroc Engineering, by the way, the company has bought a 26% stake in a renewable energy company called AMP. In fact, there's lots happening in the EV space, not just Varroc Engineering, Hero MotoCorp as well has invested in Ather. So EV space also picking up. But otherwise, not a bad opening. Not a bad opening at all, Sonia. So 35 points lower. By the way, yesterday, the entire railway stocks all pulled back. IRFC and Texmaco and everything, basically. Titagarh, everything was down between 4 and 5% after the run-up. IRFC is starting back up about 5% or so. So that is one area where there has been a fair bit of retail activity. Amber, I think we highlighted 3.5% from that space, EMI space. Lemon Tree is up 2%. These are some of the big volume-led gainers coming up on the screen. EID Parry has been one of the names from the the Chola group, which has not really done very well. I mean, actually, one of the underperformers, but that yesterday went up 5%. EID Parry is up another 3% this morning. Devyani, you guys spoke about. Keynes is up 7%.
So I was talking about these paper and smaller sectors, right? Andhra paper is up another 2.5% Sheshasai paper is coming up with a 4% pop. So yeah, I mean there is some activity. Avalon is another one of those sort of EMS players, which is starting about 3% higher. Stocks at about 600. Piramal Pharma is up about 3%. Aavas Financiers is up about 2% or so. So this is the start as far as the broader markets are concerned. Tata Consumer Survey went up 4% yesterday in the last 30 minutes on the back of that news report about Haldiram. It's climbing down. It's down 2% on decent volumes. It's a top traded loser with price activity on the downside. At least that's what's coming up on my screen. And the other one is InSwift Laboratories, which is down 13%.
Yeah.
That'll come up as well. Stocks at about 107 on volumes. Should be.
So, Prashant, all this while I was scratching my head literally to figure out why a stock called Responsive Industries is up on such heavy volumes. And it's up 14-15%. They make, I think, vinyl flooring and, synthetic leather. And then went through the exchange notifications to figure out that they were making, a lot of this for Vande Bharat. Now they have a contract for the Garib Rath. And anything that has anything to do with the Indian Railways in the market, flying away. And that's a stock worth noting. Huge volumes and price action today.
I think it's done well over a period of time as well, because it does come up occasionally.
Yeah, 150% up just in this calendar year. 2023, the stock is up 150%. It is also, among other things, it's also a railway play, and it's got another order for the Garib Rath, Indian Railways in focus.
All right. Well, the Nifty Bank is underperforming a little bit. It's down it's actually flat, not very much to complain. You've got the Nifty, which is down about 35, 36 points still. Sandeep Bhatia is head of equity, India, and country head at Macquarie Group. Sandeep, good to have you with us here. Good morning. Thanks very much for your time. Just starting with the entire EMS space, the electronic manufacturers and a flurry of initiations, etc. Do you guys have coverage at Macquarie on these names, and what do you like there? At the margin, it also does seem to be that from just assembly, players are moving on to more value-added stuff. Go on.
Yeah, we have limited coverage there. We, of course, like the sector. And the real challenge is not, whether in the next 1 or 2 years we'll see expansion. I think the value-added portion, as you just mentioned, is critical. And the biggest chunks of value-added are mostly in semiconductors and optics, whether it's laptops or whether it is phones. So I think on that front, India is still some time away. And it would take at least 5+ years for some of this to come to India. And even there, the technology and the level of manufacturing and the kind of work which is done in Taiwan, I think even the US is over a decade away. So this will take time, in our view. It's right now just a question of the fact that this opportunity never existed in India, and it's come. So that's a good thing. And the stocks are essentially flying on the fact that this opportunity is now getting realized.
By the way, Devyani International, we were talking about that. It's now at a fresh 52-week high. So, that stock is up almost about, I think 5% right now. It's up 25% this year. Consumption is coming back in a big way. There are, of course, a lot of big events as well, like the World Cup, etc. But give and take everything, this has been a very good month for Devyani International. Now at 220 rupees, 52-week high. PBR Inox is at a fresh 52-week high as well, 1850 over there. And a couple of others. Indian Hotels is at a fresh 52-week high. So consumption across the board is doing very well. Sandeep, hi, morning. How are you feeling about the mid-caps in general? If you had high amount of exposure here, is this a time to be a bit cautious, or do you think that there is a long runway?
Well, I think we are at that inflection point of geopolitics meeting global finance as far as India is concerned, and therefore everything that has some announcement around it or some potential, potential government policy to promote it is moving. Should I invest right now? I would definitely be cautious. I think on these counts, I would look at value in sectors which have actually lagged. So I would definitely want to look at some of this. The entire mid-cap space, in fact, has really moved very fast in the last 2 months especially. And we could see some more activity going forward. But for a longer-term investor who has a time horizon of at least 2 years, I think it's time to be cautious.
Time to be cautious. Okay, saying it out as clearly as it gets. Sandeep, good morning. Surabhi here. Good to be chatting with you today. So while, we take that advice on board, where are you getting, if I could say maybe a little uncomfortable right now? One of the biggest debates is on this entire manufacturing space where perhaps the longer term tailwinds are in place and we have seen a lot of spending, but then stock prices have also moved up. So is it Capex, capital goods, manufacturing? Is that an area of concern or is it something else?
So to say that something is an area of concern per se, I think would be overstating your bearish or cautious case. There are, on a macro level, there are no concerns. If the stock has gone up 20% in the last 2 months or so, then clearly there is a concern on valuations. Is there necessarily a concern on the business model? I would definitely be concerned when there is no business model and there are fantastic billion-dollar valuations which are ascribed just to some business. And that clearly is something which one wants to reconsider. But the real issue is that right now, if you look at some of the large sectors like banks have probably given their best performance in terms of numbers. The stock prices may still continue to move, which they should, because we are not in any down cycle. We are probably not even at the peak of the best part of the cycle. We are mid-cycle for banks. And to that extent, one can continue to remain invested. Pharma, again, suddenly after a couple of years, people have started looking at it. But again, I'm more cautious because it's more event-based. But yes, pharma is something which one could definitely look at. The real beaten down pack, which people should look at, is the IT sector. And here there are good quality names which clearly have not performed and not been investors' favorites. So I think it's time to actually look at some of these underperforming sectors and names.
Large cap IT, I presume, right, Sandeep? Because mid-caps have just done very well for themselves.
Correct. Yes.
Okay, got that. What about power as a space? There seems to be a real case many are making that even as we kind of completely over the next many years move away to only building renewable capacity, we are at a point where that it's too big a jump to make immediately. So you will need new thermal capacity as well in the interim, and that the opportunity could be large. I mean, so we saw that announcement from NTPC. I think we'll see more. So just wanted your thoughts there.
So the entire manufacturing sector, construction sector, which requires steel, all these are in it. Even the services sector, in fact, artificial intelligence and everything also requires power. So I think the old-fashioned power is definitely there for the next 10 years, if not 20 years, honestly. That's why we see the global oil prices still remain firm. While, the green energy transition is happening, the case for that in terms of wholesale transformation of the power sector is definitely overstated in all countries per se. So I think for the next 10 years, for a country like India, we have no option but to rely on thermal power, and to that extent, that sector definitely will see volume growth and expansion.
Okay. Any other spaces, Sandeep, where you think that there is both, price appreciation, valuation headroom, as well as growth coming back in a big way? Something that you can look at for the next 12 to 18 months?
I think the only sector which has some headroom and growth and price appreciation with much less risk is actually the banking sector. So all the private sector banks, HDFC Bank, which has been underperformer, can be looked at. I think next year it should definitely do much better. And that is one sector. The other sector probably is definitely the large cap IT sector. That has something which has actually surprised many in terms of the way it continues to be such a big underperformer. So I think we will see some inflows into the sector over the next couple of months, but it will be patient money which can wait for 2 years.
Okay, got that. Sandeep, one theme in the market has been, rock solid PSU moves. And we've seen that across the board. Even PSU banks, they've done better than their private sector counterparts, a lot of the railway stocks, defense, etc. As we get into election season, could populist spending or any kind of populist moves become a bit of a risk for the market as a whole or for PSUs in general? What's your sense on PSUs after this rally?
I think PSUs are coming back into fashion after a very long time. I think this unfortunately in India is a large part of the sector, a large part of the economy, and even potentially of the market, but which gets always, especially in the energy sector, they dominate. But they always trade at single-digit valuations. So my short answer is I don't see populism at the central level to damage valuations or the earnings story of these businesses. Populism is happening at the state level, but that will actually impact state finances. It won't affect the PSU businesses, whether it's banks or other PSU organizations. The only challenge is that we need policy clarity and stability for the longer term. And that even now, I think people don't have the confidence, even if the government, even if the BJP comes back to power again. And that is a major long-term challenge to valuations of this sector. And if that changes, that's a different thing. But I'm not betting on that. So to that extent, these are cyclical India story, India flavor moments which happen, and when they come in. I hope that continues for more than a year or so, because historical experience has been that these kind of moments are mostly short-lived.
Okay. Got that. Sandeep, good talking to you as always. Thank you very much for taking out the time and joining us on the show today. We look forward to the next chat. Well, that is a word coming in from our market master of the day. The market, by the way, is now a slightly deeper shade of red, 50 points lower. But again, if you contrast that with what's happening in a lot of the Asian markets, and this is still not bad, though, of course, we're not seeing any early recovery just yet. Midcaps are relatively outperforming. Let's move on to our next conversation. Muthoot Finance is in focus. The company's asset quality had deteriorated a bit in the first quarter. Net interest margins were also under pressure. To discuss a lot of the trends that are now shaping up in the second quarter and what lies ahead, we have George Alexander Muthoot, Managing Director at Muthoot Finance. Mr. Muthoot, thanks very much for being with us. So, it's been interesting. I mean, one clear sort of trend is that in the second quarter, gold prices have been fairly subdued, I think, throughout the last several weeks now. Overall, what are the trends in the business that you're seeing, and how does that kind of tie in on the gold side of the business as well? What does Q2 look like so far?
Thank you, and good morning. I think Q4 of last year and Q1 has been quite good. We saw good growth in the AUM, gold loan I'm saying. Gold loan AUM, we saw good growth. We also saw good, the profits also we are able to sustain the profits also. So Q2 and going forward also, we see the same momentum coming back, going forward. We had given a guidance of about 15% for the gold loan growth. I think we will stick to that. We will be able to achieve that for the full year. Now, regarding the asset quality, I think, which you initially said, that asset quality deterioration. For a gold loan company, asset quality or the NPA is never a barometer or a check for the asset quality, because the asset is always gold, good quality. So the NPA numbers which you see, if it is 3% or 4%, it's just time given, extra time given to the customer to take back his gold instead of auction. So that has never resulted in a credit loss for us. Today, our credit loss is always for a year, it is in the range of 0.1%. 0.1% or less than that is our credit cost. So I think the NPA numbers which you see always is not reflective of the credit cost or credit loss of the company.
No, fair enough. I mean, you have super collateral in the form of gold, especially on the gold part of the business. Specifically on gold loans, your AUM was up almost 6.7% quarter-on-quarter growth in the first quarter. Again, I just asked, because gold prices have come down, how are those numbers looking now? What is the LTV that you usually run on the book? And is there a correlation? I mean, when gold prices fall, Does this part of the business get hit in any way?
But it's not substantial hit or something. But first of all, I would like to correct you. The gold price is not fallen actually. Maybe a 2%, 3% fall in the price. That is always there. You don't call it a fall in the price, just fluctuation. And seeing the economic trend, international economic trend, etc., I don't see gold prices having a big fall, etc. It will only sustain or maybe gradually go up only. But because the gold price is higher, some new customers may be able to borrow a little more because our LTV is capped at 75%. So somebody who needs the maximum amount, he will get 75%. And if the gold price is falling, maybe a little less, but it is nothing substantial. We have seen fluctuations in the gold price, but overall, if you see a 1 year, 2 year, 3 year, 4 year trend, it is always rising.
Mr. Muthoot, good morning and thanks for joining in. So this 15% growth that you're talking about, right, for the full year, can you just tell us what kind of ticket sizes are you looking at? Is the focus now on low ticket size customers or high value customers continue to be the focus area? And, what do you see? Is this a sustainable growth, a compounded growth that you're looking at, 15 to 20%, say, over the next few years?
Yeah, 15% is what we have said. So when you ask about the type of customers, we have a lack of customers coming to our branches every day for a loan. And most of them may not, maybe 90% of them are the low ticket, maybe 25,000, 50,000, 1 lakh up to 2 lakhs. The high ticket, maybe 10 lakhs, 20 lakhs, 30 lakhs, big customers, probably they are not much. They come, but they are not much. But they would, if they are also, they would have a choice of going to their own respective banks also for the gold loan. But then, having said that, our customers, our forte has always been the low ticket, the general public who considers Muthoot as a good company and maybe a trustworthy company to give their gold to. So we have always banked on the low ticket customers, and our average ticket size today is only about 70,000 rupees.
Okay, Mr. Muthoot, hi, good morning. Prashant here. Hi. Could you tell us in the second quarter, what has been loan growth at?
Yeah, I think for the whole year, second quarter is also looking as good as the first quarter. So the whole, I think there can always be some months, some aberrations, or maybe going up, going down, etc. Overall, I think we will stick to the 15% growth for the full year. So this quarter also, we should see good growth. Yeah.
Okay.
Sustained.
Now, sustained at 15%. Do you believe, and we've spoken about this in the past, and you did last time you were on, you spoke to us about, you got a small housing book, you're looking at SMEs, and you'd spoken about that in some detail last time. Is there a feeling within Muthoot that eventually the only kind of a way to continue to grow is to diversify into other segments aggressively and very fast? Is that is there a feeling that you need to do that internally?
Yeah, I think. So I think the fact that you said we need to diversify, yes. Whether we need to diversify aggressively and fast is not something which we have not decided on or we are not thinking of. We will certainly diversify. Today, we have a non-gold loan portfolio of about 12%. Going forward in the next maybe 3 years, 4 years, etc., it can come to maximum of 15 or 20%, definitely, maximum of 20%. But then our forte has always been the gold loan sector, and we feel that there is a lot of business potential in the gold loan sector. Despite the fact that banks are also coming into this field, we are also able to grow. So there is lot of potential. There are more and more people are getting attracted to gold loan. But then we also understand that we need to diversify also, diversify into other loans. So housing loan is only one small portfolio. We have started the salaried personal loan also, and there's very small portfolio of the vehicle finance. But those are all very minuscule. But of the 12% non-gold loan portfolio, I think about 7 or 8% is the microfinance, which is done by our subsidiary, Belstar.
Okay. So that 12% non-gold can go up to 20%, you're saying?
Probably, yes, in the next 5 years. So, yeah, yes.
So slow and steady, not aggressive. I think that is clear.
That's what I wanted to correct you, Prashant, that we we will be looking at diversification, but not aggressively, because our forte has always been the secured.
No, by aggressive, I did not mean loosening your lending standards or anything. I was just saying to kind of, fasten up the process. But just one more thing. Last 2 or 3 our interactions over the last 2-3 months, actually more than that, you've been telling us that competition in the gold loan segment, which was intense, has now peaked off and actually is now more manageable. Just an update on that. Do you still feel that way, or have things picked up once again? Go on.
No, I think no. It's just that competition from the banks are always there. See, we have only 5,000 branches. All the 25, 26 scheduled banks and PSU banks together have about 1 lakh of branches. So you can't compare their total growth with the Muthoot. But then overall, you see, the bank's portfolio is also growing. Muthoot is also growing. It is not that somebody is taking away somebody else's business. It is that they both are growing. So more and more people are now getting, or more and more public are getting comfortable with their gold loan. That's the beauty of this now, because banks have also entered. So competition is there. It is definitely there. It is not that it has gone away, but competition is there in the business because everybody sees a potential in this business. The banks, the NBFCs, everybody sees a potential. That is why more and more people are entering. But nevertheless, we are able to sustain our growth also.
Okay, all right, Mr. Muthoot, we'll leave it at that. Thanks a lot for joining in, and all the best. That's Muthoot Finance talking about retaining their guidance of a 15% growth, AUM growth, and they say the momentum in gold loans is something that continues. But Biocon is a stock on our radar right now. The company has completed the wave 2 of the integration of the acquired biosimilar business from Viatris. The integration is for the North American markets, which is the largest piece by value for the biosimilar business, and just 60 days after the company integrated the business in over 70 emerging market countries. My colleague Ekta caught up with Shrihas Tambe, who is the Managing Director and Chief Executive Officer at Biocon, began by asking him about this latest integration and the next milestone. Listen in.
First, on the North America piece, having transitioned the largest piece by value, I think the important next steps for us would be to make sure we consolidate on the strong foundation that Viatris has built for us in this market. We're very happy that over 100 colleagues from Viatris will be coming over on the commercial side to Biocon Biologics. So the first focus for us in the immediate future would be consolidating the business that we have in North America. And then given that we have a series of products launching in that particular market in the coming quarters, we really are looking forward to growing the Biocon Biologics brand in the United States and in Canada. The third wave of our transition will, of course, be Europe and the other advanced markets, and we've said that we will do that before the end of this fiscal, and we are on track for that as well.
Okay. Well, let's talk about specific biosimilar opportunities in the US then. Aflibercept, the biosimilar which is used for macular degeneration and cancer. The company has received Health Canada approval. There is a judgment we do understand which is pending in the US markets. What is the status of that and approval timelines?
So this is biosimilar Aflibercept, a biosimilar to a drug called Eylea. And we have a first-to-file status here from an asset that we acquired from Viatris as a part of this deal. You're right that we are in a litigation with the originator in the United States, but we have received conditional approval from Canada, and also we have the recommendation from EMA in Europe. So we feel very confident about the science, about the dossier. And I think we are looking forward to the outcome of the court proceedings to see how we can bring that product to patients in the United States and other parts of the world.
What is your guidance then on the launch of the diabetes biosimilar insulin Aspart? Have you heard from the US FDA on the 8 observations which were issued to the Malaysia facility? It wasn't a product-specific inspection, but nonetheless, if you could guide us on that. And the launch timeline for bevacizumab as well.
Yeah. So as you rightly said, Ekta, this wasn't the inspection that we had in Malaysia wasn't specific to Aspart. It was a CGMP inspection. And we went through that inspection. We feel very confident. We've talked about it in the past as well. We've responded to the observations with a very comprehensive CAPA plan, and we're looking forward to hear from the agency on what whether these CAPAs are acceptable to them. On asphalt specifically, we believe we should have an approval towards the end of the year, but we haven't heard from the agency specifically as yet on that. We've heard that they would need a pre-approval inspection. We will seek clarity whether they will accept our current inspection towards that end or not. On bevacizumab, we've said that we've responded to the CRL. So we have sent our comprehensive response to the agency, and we are quite confident and hopeful that the agency sees the responses as adequate, and we should have that approval coming over as well soon.
Okay, and what about adalimumab? Is there also an interchangeable opportunity there?
So adalimumab, we've already, as we got that asset over from Viatris, that particular interchangeability trial had already been started. So that interchangeability trial is currently ongoing, and we will see that interchangeability status come to us over the coming quarters.
What can you guide us as well as the market when it comes to your total debt on books, which stands at around $1.4 billion?
So as we've said, even in the past, that we feel very comfortable with the level of debt that we are operating under at this stage. We understand very well that historically we've been a very debt-free organization, a company that has not had any debt on our books. So it's very different from what we're doing. But we are also right now realizing a very transformational opportunity from where we were before the acquisition to where Biocon Biologics is going to be. So it's a very, very unique opportunity for Biocon Biologics. We feel confident given the response that we're seeing for our products, not just in the United States, but in Europe and other parts of the world, that the operating performance being strong, we'll be able to service debt through the business performance itself. And we've seen, interest in equity fundraise that we talked about in the past. And you should hear from us, in the days ahead on how we performed against that piece as well. So we see this debt at a comfortable level, but we will look to bring this down, as we've said in the past, in the coming days.
To how much? What would a comfortable level be?
Yeah, and I think it's really a question of, when we are clearly, creating value in the organization, then do we really dilute in the immediate term? At what value do you dilute? And then do you want to hold on and do this when you've actually created more value and closer to the IPO? So these are some of the questions that we would be dealing with. And we will have to make a determination of what that right debt to equity ratio would be before we make that call. I'm not going to discuss specific ratios today, but clearly we will be moving from where we are today to a much better ratio.
And what about the IPO?
On the IPO too, we've said right now our focus is that we will consolidate this business. We will integrate the Viatris acquired business into Biocon Biologics. You're seeing that we had a 2-year TSA with Viatris, but we've been able to significantly accelerate that period. All of this goes on to say that the organization feels confident. We believe that we should be in a position to at least be a year ahead of what we said in terms of the integration plans. Will then be the right time to start discussing the specifics around the IPO timing.
All right, that is the latest from Biocon Biologics. With the Viatris acquisition now fully integrated, we will take a break. On the other side, excerpts from our exclusive conversation with Axis Bank's Amitabh Chaudhary coming up in just a bit. He speaks about, of course, growth in the business and competition from fintechs from the sidelines of the Global Fintech Fest. Welcome back. You're with us on Corporate Radar. Let's move to the next interesting piece of sort of corporate conversation that we have for you. And this is a CNBC-TV18 exclusive from the ongoing Global FinTech Fest. Our colleague Ritu Singh caught up with Amitabh Chaudhary, MD and CEO of Axis Bank, and began by asking him about the competition from fintechs to banks and if there's a headroom for fintechs to take away customers and a part of the profit pool as well. Take a look.
You know, when you talk about the regulations can act as a moat only for a short period of time.
Yeah.
End of the day, if fintechs come with the right innovation, the right product, the right customer journey, I think they can continue to take customers away from the banks. And if you're not, we don't react or are not proactive about it. So in my mind, a couple of changes have happened post some of the regulations that have come in. I think the fintechs have had to rethink their model a little bit.
Yeah.
I think they have realized that regulation is not a bug, but is actually a feature which they want to have in their operating model, and a very critical feature.
Yeah.
So they have to put compliance with regulations fair and center of how they go about building their business models. And I think that realization has dawned very quickly, and a lot of fintechs are repivoting their model. But there are large fintechs out there who are providing services to customers, who are interacting on their platforms on a very large scale.
Yeah.
So from a bank's perspective, the reaction to whatever is happening is, I would say, twofold. One is you first continue to innovate yourself and ensure that you continue to attract customers directly.
Yeah.
And second is that you work in partnership with all these fintechs because they are attracting a customers of a certain kind who are using a certain service. In many cases, a bank can come in and supplement and complement what those platforms are doing. And that's precisely what, say, a bank like us is attempting to do. We have huge number of partnerships, some very, very marquee partnerships.
Yeah.
And I think we're only building them over a period of time.
Let's broaden the pool a little bit because, public sector banks that have been saddled with bad loans are coming back stronger with cleaner balance sheets. You have larger private entities being created, your former HDFC Bank merger. You have Jio coming onto the scene. Aside from fintechs, who's the biggest competition for Axis Bank at the moment?
See, all our competition, and the competition is evolving as you rightly pointed out, that public sector banks are coming back, fintechs are becoming more important and prominent, Jio Financial Services are talking about making a big play in the market. The good news is that Indian opportunity is very large. It is only growing. The fact that all of us are here and so many people are here, they see India as a place where a lot of innovation, a lot of growth can happen in a short period of time. And I think it's a question of how you play on that opportunity rather than all the time worrying about, I have a certain scale and how do I protect myself. I think you should be thinking about how can you grow in this platform which is going to get created for India in a very, very big way in the years to come. So yes, competition is welcome. Competition will always be there. It will always, new competition will keep coming. It's a question of how we react to it. I mean, at least in case of Axis Bank, we are seeing this as an opportunity, and that's exactly how we're going about it.
So let's talk about Axis Bank, for instance. It's been a stellar first quarter for most banks. But, one thing we've been seeing playing out is the pressure on margins because of the liabilities getting repriced. In a scenario where inflation is high and RBI may continue to hold rates for a while, what will that mean in terms of your margins and growth outlook?
So the repricing of deposits is still in play. It's not that the repricing of all the deposits has happened, which means that the net interest margins will remain under pressure for a little bit of time. Yeah. Obviously, every institution realizes that and is trying to ensure using a combination of what kind of asset classes you're pushing, what kind of yields you want to push, if and when the interest rates are cut. Because then again, the loans will reprice faster than deposits. You would see net interest margins coming under pressure. So I think that is some distance away. But in the interim, as pricing of deposits completes, I think the margins will remain under pressure and then hopefully stabilize till the the interest rate cut starts to begin.
At 22%, your advances growth has been strong in the last quarter. But deposit growth has been lagging, and that's a problem that the industry is also facing. I wanted to understand going ahead, if this gap continues to widen, won't it affect your ability to disburse credit? How do you see that remaining?
Well, it impacts the ability of the entire industry to continue to
Let's talk about
credit.
Axis Bank.
Yeah, so in that sense, yes, at some stage, the deposit growth does need to catch up with the credit growth. Otherwise, we will struggle to, continue to grow advances at a certain pace. As you again rightly pointed out, that the growth on the CASA side has been slow. I think what you will see is a lot of banks are doing very well in terms of growing their term deposits. But yes, I cannot take away the fact that if deposits growth remain muted, at some stage credit growth will get impacted.
Mr. Chaudhary, to quickly also touch upon your latest deal that's been in the news. You've announced an additional 6% stake in Max at the price of 113 rupees per share. How do you justify the price, and how do you think the regulator will look at it, given that currently Max is trading at, say, 890 or so a share, and a large part of that business is the insurance part of the business? So do you think there's a bit of a regulatory overhang there?
No, so I think when the regulator revised the guidelines, it made it very clear that the methodology for determining the share price has to be on the
fair pricing formula.
We have followed exactly the same formula. There was a transaction which happened in Max where Mitsui moved from Max Life to Max Financial Services, where a similar formula was used. They, at that time, had done the transaction at somewhere in the mid-80s. Okay. So it is not that we are using some different formula. We are following the guidelines issued by the regulator, and we are following the guidelines to the T. Now, again, this is all subject to approval from Reserve Bank of India and IRDA, and we will go through that process. Our view is that, firstly, a transaction of this nature has happened in the past, and we obviously continue to follow the same guideline in doing this transaction.
And, yet we've had the insurance regulator questioning Max, seeking certain clarifications in the deal. We also had SEBI recently, seek these clarifications. Has SEBI reached out to you on the matter yet?
See, when the initial questions were raised on the transaction itself, and I'm talking about
the last
time, at that time, as part of the inter-regulatory governance, I think IRDA had informed SEBI and RBI about the questions they had raised and some of the discussions they've had with Max and Axis Bank. I think it's part of the same thing. There's nothing new has happened which I'm aware of. So the regulators do talk to each other, and as part of that transaction, they were talking to the other regulators and sharing with each other what exactly the nature of the transaction was and how it has panned out. And I think this latest article or this news item which has come around SEBI is just related to that, nothing beyond it.
But, SEBI is in the last leg of its investigation as far as your first transaction was concerned. And, it's estimated...
I'm not aware of anything of that nature, so when SEBI reaches out to us, we'll let you know.
Well, compared to the 32 rupees per share price then and 113 rupees per share price now, it is estimated that shareholder loss could be 1,800 crores or so. How do you think this would play out in the regulator's eye?
First, please understand that all these transactions are done with the permission of all the other shareholders. You're not going and doing something in isolation. The other shareholders of Max Life approve this transaction, only then something like this goes through.
Sure.
So it is not that it is done at the cost of someone without their knowing about it. It is all done with agreement of everyone else. And as I said, we have just announced the fact that we intend to do this transaction. We still have to go through the approval process. Let the approvals come through when then we'll actually do the transaction.
The Citi deal, that's another one that you've now finally been able to close. Has it played out the way you anticipated? What are the synergies you've seen since the 1st of March when the integration was completed?
Well, it has played out exactly the way we thought it will.
Despite Citi losing a lot of customers in the process.
No, that is all media. See, again, please let's understand. When Citi started talking about this transaction in the first place, that was in March 2021. Then they came to the market with the deal in June, July 2021. The transaction was consummated on March 1st, 2023. Now, during that process, Citibank might have lost some clients. And it is obvious that when you do something of this nature, you will not only lose some clients, you'll lose some employees also. And that has happened.
No doubt.
In our structure with Citi, the transaction which we had kind of signed up with them, we had mitigated the risk of something like this happening, and you did see that the overall value which you paid to Citi did come down because they had lost a certain set of customers, which is beyond the framework which is set up.
Agreed upon.
Post the acquisition, both on the employee and the customer side, I don't know where media is getting its numbers from because we are not disclosing any numbers. We are just saying that the 97% of Citi employees came to us. The attrition rate is lower than what they saw in the 2 years before the acquisition, and the customer retention has been extremely high and as per our expectations.
My very last question to you. Recently from Axis Bank, we've had Neelkant Mishra being appointed as the chairman of UIDAI. Just quickly wanted to get your comments on that.
Well, congratulations, Neelkant. I think it just goes to show that we are attracting talent of the highest order, and we obviously encourage our people to engage with the government and get involved in some of the policy-making issues. Neelkant has been at the forefront of this for quite some time, and we are just truly delighted that he was seen fit to be appointed the part-time chairman of UIDAI. And I hope more people like him get appointed from the Axis fold over a period of time. So quite delighted.
Okay, well, that's an interesting conversation with Axis Bank CEO and MD Amitabh Chaudhary. My colleague Ritu conducting that interview. Wide-ranging, I mean, actually, and we'll continue to play snippets of that conversation through the course of the day. Well, you know, you got the market, which is looking down, but out 24, 25 points lower. 19,586 is where we're at. Maybe with 45, 50 minutes of trade behind us, it makes sense to look at the market breadth, and that'll give you a sense of the health of the overall market, which is absolutely fine. You know, 1,300 stocks are higher, and you've got 740 stocks which are lower. This is overall NSE advanced decline, so no problems. Look at Cochin Shipyard, right? I mean, I don't know if there's any news flow here, but 15% higher on Cochin Shipyard. Stocks almost at 1,100 rupees. It is the biggest price volume gainer in the market. But it's not just Cochin. You know, the shipbuilders are back. Look at Mazgaon Dock, 5% higher. You know, it's almost like they go up 15, 20, 25% in a week's time. Then they take a break, 2-week break, holiday. And then, you know, the move again starts again. Not Mirza, Mazgaon Dock is what I was talking about. 2005 on Mazgaon Dock. And you also look at Garden Reach Shipbuilders, which is nearing the 900 rupee mark. So 6.5% there. Stocks at 874. So all three shipbuilders, listed shipbuilders, doing very, very well. So that's a new kind of, a new set of names which have come into this morning. We'll take a quick commercial break here. On the other side, we shift our focus to the commodity markets. Manisha is here with that in just a bit.
Welcome back to Bazaar Morning Call. Well, for now, let's get Mitesh Thakkar on board to tell us how to approach the markets. If you look at the headline index, there's not too much happening, but a lot of the action actually is in the mid-cap space. So the mid-cap index is now up about 130 points. Mitesh, thanks for being with us. What do you do on the headline index? And more importantly, any mid-caps or small caps where you can take a fresh positional trade now?
Good morning. So I think avoid the index. I was talking about taking the fact that around 19,650, 19,700, good time to exit the index, wait for a good dip to play in, and then try to get in back to the index. But stock specific wise, we had all buy calls, and I think the idea remains to find these breakouts which are succeeding in the mid and the small caps and try and take longs over there. Even apart from that, I think in the large cap space also we are trading with long buys. So it's a very stock specific long kind of a market for me, while we have been totally avoiding the Nifty, the bank Nifty till for many days and Nifty since yesterday. So I think that's the way we'll approach it. And on the stock side, cement as a pack is looking very strong to me. So I have a buy on Ramco Cement. That's a buy with a stop just below today's low of 902. Keep a stop at around 900 and look for a target of around 930 to begin with over here. And the other stock which I like is Gas Authority. Not exactly a mid cap, but it's been making fresh highs. So GAIL is a buy with a stop at 123.5 for targets of 132.
All right, got that. Mitesh, thanks very much for the trading calls. With that, let's now move our focus to the commodity market, see what's happening there. Manisha is joining us now. Manisha, what's on your radar?
Well, I'm looking at the metal prices, and the last week or 10 days have been good for metals. Today, can't say the same about the sector because there is a bit of a decline as the US dollar index has surged back up yet again at 5-month highs. We're nudging that 105 mark there. And the markets also are reacting to the China trade data that came in today in the morning. While the surplus has been the smallest in last 3 months, it really is about the export and import number that the street is looking at. So when you look at the China exports, we're looking at 8.8% of a contraction on a year-on-year basis. But this is much lesser than 9.2% that the street was estimating. The Chinese import numbers as well has seen a decline, and this is a decline for 8th straight month. 7.3% of a contraction. Street was anticipating 9%. So in that sense, the numbers aren't so bad really. I want to take you through basic fundamentals for some of these metal prices. Aluminum today, of course, has opened slightly on the weaker note, but even with that, we are trading at a 1-month highs at this point in time, and that is after China has halted expansion of production capacity beyond 45 million tons. This has been done to ensure that there is not excess supply in the international markets, and then Indonesia also banning bauxite exports, which is the major ingredient for aluminum, has been supportive. So when you look at the last 1 week or so, aluminum prices still are trading in the positive there. Iron ore, let's talk about that one, and that has seen a phenomenal run-up. 4-month highs at around $117 a ton. I mean, for iron ore, most banks and brokerages kept telling us that 100 is going to be a resistance, but a very strong run-up, and that is because the steel demand, steel output in China has been on the positive side. The higher steel output also has taken the nickel prices to nearly 1-month highs. Apart from that, here as well, it has been about tight supplies in Indonesia. It also has to do with delayed quota system or allocations that Indonesia is looking at, and that has been supportive. Also, demand from steelmakers being on the positive side has taken prices higher. The only metal that has actually underperformed in this week has been copper prices. We have seen prices decline because the yuan is trading at a 10-month lows versus the US dollar, and copper is more in sync with the macro numbers, and that haven't really been very strong. For copper though, even here, if you look at the prices that we saw in the month of August at around 8,100, we are trading at around 8,400. So here as well, we are trading on the positive side. So on a week, on a month notice, we are still positive. It is today that the markets have reacted slightly weaker.
All right, thanks a lot, Manisha, for that. Well, let's do one thing. Let's talk about some of the buzzing stocks. InSwift Laboratories is on our radar. Mangalam is here to tell us why he's tracking that one. Mangalam, over to you.
Well, you know, the stock was up 20% yesterday after an announcement of the deal, and that is when we alerted the viewers as well that the deal is, there are curiosities in this deal itself. The stock is now down 17% on account of the same. And this is not a comment on the quality of the business, but more on the nature of this transaction. So let's tell you, the company yesterday announced that they've sold their API and CRAMS business to Synthemed Labs Private Limited for about 1,650 odd crore rupees. For that, they said that they had 800 crore of debt, and that meant the valuation of the company's equity was around 850 odd crores. This was at a premium to the last market cap of the company, which was 730 odd crores, and which is why the stock moved higher. However, if you just take a look at it deeper, you would realize that the company has effectively sold its entire business, because the turnover of the business that was sold was 96% of the company's overall sales, and they sold it on a slump sale basis. What the street would have actually liked is had they sold it, effectively on a whole basis, and as a result of which the minority shareholders would have gotten an open offer as well. But the next step was that now that they've sold this business, what do they do with the money? Would there be a big dividend or not? Well, at the same time, the board also approved grant of unsecured loan of up to 600 crore rupees to InSwift Limited, which is a related company itself, and then eventually there would be a merger of InSwift Labs with InSwift Limited. So one would be, a little curious about what InSwift Limited does. At the same time, their board also approved raising debt limit from 1,500 crores to 2,000 odd crores, And for that, InSwift Limited had a market cap of just around 120 odd crores. So all of this piqued the curiosity, and perhaps the street doesn't like this, and as a result of which the stock is lower today.
All right. So, yeah, there's a big one, 17% lower, and interesting one, Mangalam. Thanks very much for highlighting that for the viewers. Now, Kane's technology is the one which is jumping up once again. Vivek is here with more on this one. Vivek, morning.
Well, good morning. Earlier today we highlighted, how CLSA had written a note on all of the EMS companies. They initiated coverage on Dixon, Amber, as well as Kane's. We are highlighting Kane's. It's a sharp mover in the session so far. What CLSA has to say is that, number one, they have an outperform rating on the stock, target price of close to 20 to 30 rupees a share. What they're saying is that the company is likely to benefit from India's thrust as far as electronics manufacturing is concerned, and it's a well-diversified services player. Along with that, what they're saying is that the company has presence across key very industrial segments and low customer concentration that they see is a positive. Along with that, they are quite positive as far as the three-pronged strategy that the company employs in terms of raising capacities, improving backward integration, as well as new capacity and customer addition. Along with that, given the fact that Keynes has a higher exposure to automotive, they believe that it would be a key beneficiary from the thrust seen over there. Lastly, what they're saying, the order flows as well as the strong order book that the company is seeing gives confidence of a strong growth over the next 3 years. They are actually anticipating a 39% CAGR return in terms of revenue from FY23 to FY26. They believe that the company actually will enjoy a higher margin mix than global peers, which is why they continue to remain positive on the stock.
Okay, thanks a lot for that. That's Keynes Technology up almost 5% Let's slip into a quick break. On the other side, it's our special segment. It's the economy. Lata will get chatting with Chetan Iyer, a chief Asia economist at Morgan Stanley, on the kind of economic slowdown that we're currently seeing.